Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's usually about wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com is where I dive deeper into all of these topics and potential individual companies on what I'm investing in. We still have coupon code Mayday that is active, MAYDAY, if you'd like to join. So we're going to start with a quote here, investment wisdom. The only way for investors to significantly outperform is to periodically stand far apart from the crowd. So that's basically being bearish when others are bullish and be bullish when others are bearish. It's buying when there is fear in the market. And that is incredibly hard for people to do. They chase price performance and they don't want to buy things when they're cheap and down. They almost always want to chase price movements. Almost always. Christine says LBRT believes there's no growth to U.S. shale production with current frac spreads. Someone better tell the EIA Gov. So I'm just going to read this whole thing. The frac industry trends have moderated marginally in recent periods on the heels of slightly softer drilling activity in both oil and gas basins during the first half of 2024. Industry-wide completions activity has declined to levels consistent with approximately flat oil and gas production. For the U.S. to deliver rising oil and gas production levels, completions activity would need to rise. Signs of tightness for quality frac crews may emerge in 2025 on a demand pull for energy. The attrition of older equipment from higher intensity fracs with increased horsepower requirements is reducing the available horsepower to meet frac fleet demand. So right now, completions activity are consistent with approximately flat oil and natural gas production. Coming to Dr. Copper, it says Dr. Copper is falling apart. Is trouble brewing for the economy? And you can see the larger selling pressure that we just experienced here on July 18th. There could be a slowdown in the market. We've got the yield curve inverted. We've got interest rates that are pretty high. We've had these interest rates high for a pretty long time. So really what's going on now is we've got those interest rates slowing down the economy, and then at the same time, we're pumping a bunch of fiscal spending into the economy. So who's going to win in the end? That is kind of what everyone's trying to figure out, I think. Is fiscal spending going to overcome the slowdown that we are experiencing with increased interest rates? I don't know. I mean, a lot of people are speculating that the slowdown is here, that a recession is coming. That very well could be the case. All I'm going to say is I don't know. I'm going to ride through it. And if we get better buying opportunities, so be it. And I will take advantage of that. CEO Technician says, don't panic, but FCX, which is Freeport McMoran, a large copper company, just snapped the neckline of a multi-month head and shoulders top, in his opinion here. And it looks like we could be breaking lower. So in the short term, yeah, we could get a pullback even in copper as FCX, Freeport McMoran, which is a very large copper company, mining company, is starting to break its neckline. HFI Research says, I'm telling you guys, something fishy is going on with the way OPEC plus exports are going about. This is not normal. The physical oil market is already screaming out some of these signals. Yeah, so what's going on there? Did you guys see the exports coming from OPEC? They are way, way down. Now, what makes me think, you got to think a little bit out of the box. Maybe they're lowering these exports because the United States is trying to do something. like they're trying to crash the market so they can refill the strategic petroleum reserve and do some things on that front. And maybe maybe Saudi Arabia or OPEC Plus knows what they're trying to do, and they're like, no, 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 we're going to beat you. We're going to ramp down exports dramatically. So maybe them, doing these fishy things, it's like they're ramping down oil so much to basically squeeze the oil market at the same time of whatever the Federal Reserve might be trying to do. Because a lot of these things, they forecast ahead. And we very well there could be a false flag event here at any second. There could also be something like COVID 2.0 or something like that, whatever the heck they're doing. If that's the case, that means that people know about whatever's coming before it actually comes. Isn't it fishy that all the tech guys already sold out? Jeff Bezos, Bill Gates, Mark Zuckerberg, the Waltons, on and on and on and on. Isn't that a little bit fishy that they all kind of sell out right before this? The yield curve's inverted. That's generally when they do these things. So we'll see if something does occur. It would occur when the yield curve starts to drop. And that means that the banks already know what is coming because they're positioning money before that thing actually occurs. It means they already know that something's coming. So watch the bond market, see if yields fall, the 2-year specifically and the 10-year. And that means something's coming. But maybe the OPEC guys are front running that thing that's coming. They're like, nope, we're gonna block these guys from getting SPR barrels at $60 a barrel. We're gonna drop exports. Or maybe there's something that's generally wrong with OPEC. Maybe. Tavi says, meanwhile, the tech sector now represents 44% of the S&P 500 index, when including Amazon, Alphabet, and Meta. The pendulum has probably swung too far in one direction, and investors are running out of ideas to justify these historical distortions. Unless this time is different, we are likely at a critical juncture for the U.S. equity markets. And this is the technology sector weight in the S&P 500. The tech bubble was 34%. The peak of 2021 was 41%. And now we're at 44%. This seems like we are way too heavy in tech. This also means that we're earlier in the commodity bull market, perhaps, because I have a feeling that this is going to go down, that we're going to get some sort of slowdown in tech. I don't think we can ride tech and be at 44%. I think this is all going to have to reset at some point. So, again, we'll see what this does. We'll continue to monitor it, and it is at extremely high levels, bubble levels for tech. The whole market's now getting trashed. Is it over? Question mark. Yeah, we are seeing a lot of selling pressure across the board. And that's what happens when you start to see weakness in the markets. Everything kind of gets sold indiscriminately. And I'm surprised that the yield curve is still inverted. A lot of the times that yield curve uninverts. But again, we are in this weird situation with high inflation. And maybe this more or less could be more of a stagflation type of environment where yields stay high, we get a slowdown in the market, and maybe things don't slow down across the board evenly like we've seen in the past. Maybe it's certain sectors and other sectors go up. It's kind of a weird situation right now. JC Parrott says, in case you haven't paid attention, stocks move based on positioning or a lack thereof, and not because of what some people refer to as fundamentals. If this is about a stock, then the conversation should be about the stock. The company is secondary, and that's putting it nicely. But he's a real big technical analysis guy. So a lot of the technical analysis guys, and they have valid points, it's about money flows and money rotation and positioning. That's really what it's about, and it's about going through these real estate cycles and other business cycles where money moves differently in the system. It moves from technology and then away from technology and into bonds, or away from bonds into commodities, and it moves in that area. They use technical analysis to identify that movement to see where we're at in the cycle. That's what they're doing. So a lot of these guys, when they look for money on the time frames that they want to make money in, it deals with money that's flowing from sector to sector. It's positioning. It's not so much about the fundamentals. Now, the fundamentals and the value investors, they look for the positioning in the market, and then they see the positioning is over here, and it's not over in this other sector. And when it's not in that sector, it creates a potential value investment. So the price draws down. You get this value gap between the business and the price, and then they buy it. Then they wait for this positioning to come back into the sector with time, and then it pushes the price back up above the value of the company. So they're playing the opposite of the positioning. So the technical guys are trying to front run the position. So they're trying to get it right when it's starting to inflect up. The value guys buy it when no one's in the sector, and there's a difference between the price and the value of the business, price of the stock and the value of the business. So that's kind of the way those two are playing it. The Hedgeless Horseman says, just a reminder of how a junior can look in a bull market, and these massive pullbacks sprinkled all throughout the bull market. It's not easy to hold on to some of these companies, guys. This is Defiance Silver Corp, 24% pullback, 16, minus 30, minus 18, minus 31, minus 30, minus 31, minus 17, minus 11. There's all these big pullbacks going across the board as it goes up. So you have to ride through that volatility for that. Technical analysis is hard because what's driving this is on a longer time frame than the shorter time frame stuff. So what's driving it? And in my opinion, it's the uninversion of the yield curve. It's the fear in the market. And this will go up so long that that pressure and that tailwind is behind the sector. That's how I view it. So you have to stay long and ride through this volatility as long as the tailwinds are there. QE Infinity says, I never use it, just a glorified search engine if you ask me. And it really is. That's what artificial intelligence is, effectively useless. And it's created a fake it till you make it bubble that could end in disaster for James Ferguson, founding partner of the UK-based macroeconomic research firm Macro Strategy Partnerships. And here it says, AI still remains, I would argue, completely unproven, he said. And that's the way that I view it at this time. I've gone on ChatGPT like 1 or 2 times just to try it out, and I never went back. To me, it's just a glorified search engine, what he says, completely true. But it's only as good as what they feed into it. And I could see whoever feeds the information in to be a bunch of garbage. So garbage in, garbage out. I asked a bunch of different questions, and it came back with a bunch of woke answers. I'm like, no, I'm not cool with this. See ya. Here is, we use to call these headwinds. So increased dollar and yields, and now they are falling and breaking those downtrends to the downside. So we could see weaker dollar, weaker yields. And that's the correlation of yields and dollar here linked up recently. And that's what I've seen myself, is the correlation between yields and the dollar. Jesse Felder says, currencies do not typically remain persistently over or undervalued, and instead they gravitate towards their fair value. As the chart below shows, that translates into a secular weakening of the dollar over the next decade. Now, this is really interesting. Why? Because there are investments that do incredibly well when the dollar drops, like emerging markets and stuff like that. And then there are specific companies and sectors that do very well when the dollar drops. So if this is true, if the dollar's set to face in a secular decline, The last time that occurred, if you look back, was 2000 to 2011. What went up during that period? Precious metals, gold and silver did. Steel stocks, aluminum stocks, base metal stocks, all of those things went up dramatically. And that's probably going to come back down and be started. It'll start with maybe a slowdown in the market and yields start to drop a little bit. Then it'll probably turn into yield curve control at some point, and the dollar is where the pressure is going to reside. So if that's the case, I think we're going to see a big commodity bull market because the dollar is going down. That's exactly the same setup as the year 2000-ish, early 2000s to 2011. Peter Lynch says, I don't believe in predicting markets. I believe in buying great companies, especially companies that are undervalued and or underappreciated. Think about that. The rapid transition narrative is crumbling. It says Ford pivots from EV plans to heavy-duty trucks at Canada facility. That's kind of pretty much a 180. Heavy-duty trucks from EV, 180 shift. Joel Greenblatt says, you can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating, and it's critical that you understand why the market isn't seeing the value. Yes and no, because remember what I talked about a few things up, how money just rotates from sector to sector, and that's kind of just sentiment driven. So you can find value in a market, and you can combine sentiment and the cycles together. And that's where the value comes about. It's from being out of cycle and having negative sentiment. It's the combination of those two things. High value financial advice. Spend less, save more, wait longer, lower your expectations. Waiting longer is a key to making a lot of money. And so if you want to make a lot of money, you have to adopt things that other people don't do. Most people are very impatient. They do not wait longer, and they don't wait for that investment to really materialize. Obviously, they want things today. They don't save a lot, and their expectations are super high, even though they have short time frames. Here's Rick Rule. It says the silver price went from $1.50 to $50, but a couple of silver stocks made that look silly. Sadly, I didn't own them. I was too young and too dumb. But I watched Quarter Lane go from 10 cents to $65. That's the kind of quantum I'm talking about. Yeah, that is. And there are, or could be, some silver companies that do something like that. And I'm positioned hopefully in one of them. I just need one, guys. I don't need a couple. I just need one with some money in it. Going from 10 cents to $65, that is ridiculous. I mean ridiculous. A couple more quotes. If you can't find any companies that you think are attractive, put your money in the bank. And Warren Buffett says if there's nothing smart to do, cash is the default option. We've got D.R. Horton here, DHI Clean. So D.R. Horton is a home builder. Their GAAP earnings per share of $4.10 beats by 31 cents. Revenue of about $10 billion beats by $360 million. I thought home builders were, we were in this big bubble. Why are they beating earnings? Have you guys seen the home builders rocketing higher? Did you also see the housing starts are up a little bit? They are up from the month before. I think it went from 1.2 something to 1.3 something. But they are beating earnings. And we'll see if that continues into the future. I posted this. This is asset inflation sensitivity since 1950. So this is the correlation of real and financial assets with inflation since 1950. Real assets have a high correlation to inflation. So do commodities. Platinum is number 3. Real estate's number 4. Diamonds, gold, collectibles. We've got cars down here. And then we have palladium down here. It's not as sensitive, and silver's way down there. So platinum is actually the most sensitive to inflation from 1950s forward of the precious metals. Gold supply forecast by Barrett Gold. It says gold production history. Find the gold bull markets in history and see if they are similar to the forecast today. This is historically, we've got these big declines in gold production, and those have all resulted in big bull markets in gold. We also have a forecast by Barrett Gold from 2020 onward that we've got a declining production or supply of the gold supply. So it's the same setup as all the other gold bull markets, guys. All the same setup. And it's also the same as some of the stuff that we showed up here for a dollar that's set in a secular decline. That's another thing that is similar. And technology being overweighted, this will roll over, leading to what I think will be the beginning of that DXY drop. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys next time. This is Finding Value.